There's good news and bad news about the economy, and this week is going to be one of the most critical weeks that we've had all year long. I'm going to start by first breaking down exactly one of the concerns. One of the concerns we face now is that broadening employment growth, which is actually really great for humanity and people and the economy and GDP across the board, broadening employment growth potentially leaves the Federal Reserve in a place where maybe they need to wait a little bit longer before cutting. GDP estimates right now are sitting at 2.5% via the Atlanta Real Now GDP measures. And one of the reasons T.S. Lombard suggests we have time to wait before cuts is even though tech and finance has had way more employment than our previous trend line, which means we have this extra sort of level of fat right here. That's all the extra sort of fat of extra employment. We don't have that extra fat. In fact, we're too lean in the category of restaurant, health, retail versus prior trends. And that leanness, as well as in all other private sectors, that leanness, which is below trend, could actually lead to a sustainable, continued beat of jobs numbers. Look at the jobs numbers that we just got Friday. We substantially beat everyone's expectations. I mean, there was no economist last week that thought we were going to get the jobs numbers that we did in terms of how high of a number we got. And we even got a positive revision for once in January. The January numbers were revised up for employment. The survey this Friday was 214. We got 303,000. And we even saw the household survey move up. So across the board, that last employment report is like, this economy is doing great. So obviously, the good news here is the economy is doing great. And what does well with the economy? Well, things that tend to do extremely well. Regular spending. That's not to say that consumers aren't loading up in debt, but really, while I do agree the next recession could be driven by a consumer debt bubble, basically because people will buy now, pay later everything, and eventually you'll have to refinance all your buy now, pay laters, and if you can't do that because you lose your job, well, then you have a problem. But that's nowhere close, I don't think. I think that's still years out. What's actually much more interesting is, like what we wrote over on ehack.com, is companies like Blackstone are now making bets that the real estate market is bottoming. They are now acquiring AIR Communities. It's a luxury real estate REIT. That's redundant, real estate REIT. But anyway, it's at a 25% premium for $10 billion because they see the recovery, the pillars of the real estate recovery coming into place. They bought a stake in a $17 billion loan portfolio backed by a lot of real estate last year in Signature Bank. In December, they spent or have agreed to a $7 billion partnership with Digital Realty for data centers. And then earlier this year, they bought a 38,000 single-family home portfolio for $3.5 billion. Blackstone doesn't do this if they think the economy is about to crash and we're about to go into a recession. So really, recession bets are kind of leaving the table. This is the same thing as what we saw with, what Janet Yellen's been yapping about, which is, hey, no recession, soft landing, right? Now, we do have some issues that come with that. One of the issues that comes with that is the Fed funds forecast for rate cuts is starting to shift. The market is starting to pair expectations of Fed rate cuts. We went into the year thinking we were going to get rate cuts in the neighborhood of 6 to 7 times. Now we're only pricing in a little bit more than 2 rate cuts for the year. The blue line is the market's expectation of the Fed funds rate, and the pink line or purple line here is where the Fed has forecast via their summary of economic projections where rates will go. Now, the issue with this is Jerome Powell, I think, is stuck between a rock and a hard place because he keeps telling us that inflation expectations are anchored, that they're well anchored, and they've remained well anchored. But at some point, I think Jerome Powell either needs to give up the lie or start projecting reality here, but he might not, and I'll tell you why he might not. But these are inflation break-evens, which are one measure of inflation expectations. You could say that the University of Michigan inflation expectations have been stable, but when you look at the 5-year break-evens, what you find is we're at the highest level we've been over the last 5 years, and we've been skyrocketing on inflation break-evens since December. This is leading bonds to move up. You've got a sell-off in the bond market. It's not a surprise to me that you have a sell-off in the bond market. You're at 4.42 on the 10-year right now. Why is it not a surprise to me? Because right now you don't have to buy bonds to get a delicious yield. I'm not affiliated with this product, so this is not a sponsorship. But look at this. You could just go right here. Go to a Vanguard Treasury Money Market Fund, ticker VUSXX. I get nothing by you investing in this, I promise. I have nothing to do with them. I don't even invest in them personally. I use the Fidelity version of this, but I actually think the Vanguard one's a little bit better if you have exposure to the Vanguard one or you already have accounts with them. But anyway, the Vanguard one, 5.27% 7-day SEC yield. You do have a 9 basis point expense ratio and a 3K investment minimum. But look at this. You're getting 5.27% minus this, 0.9, so you're getting 5.18%. On T-bills, you're at like 5.1%. You're getting more money in this money market than you're getting on T-bills right now. Now, of course, if rates go down, this can fluctuate, but right now expectations are that rates might actually go up, not down. See, the problem is repeating the mistake of the 70s, where you cut rates, and then all of a sudden you have to raise rates again, and you send a signal to the market that the Fed doesn't know what the hell it's doing. And the Fed is already on thin ice. They screwed up with the inflation is transitory argument with how late they were to raise rates. And yes, while it may be true that eventually inflation will be transitory, it wasn't good enough to help us anchor inflation expectations down. So you create this nasty risk factor now that, personally, I think the Fed's probably going to have to wait to cut rates until September or November before actually driving rate cuts. Because if they cut too soon with these sort of job numbers and these lagging gains for job numbers, then what happens? We risk having to raise rates again, and then we break inflation expectations. That would be the worst case scenario, especially as we're seeing wages also rise. Remember, folks, California just raised its fast food minimum wages to $20 an hour, unless, of course, you're associated with Gavin Newsom. That's really a topic for a different video, the Panera Bread discounts. But one of the things you have to consider, and a lot of people won't, is they go, well, that's just California. That doesn't affect the rest of the world or the United States economy. Well, according to Bloomberg Intelligence, it does. They actually think that ECI, the Employment Cost Index, could come in 0.2% higher than where it would otherwise come in simply because of California's wage increases. Now, again, I'm supportive of people making more money. I think that's actually what expands this economy. It's one of the reasons you could see, I think, a company like Amazon hit a crazy new all-time high. People just have more money, they make more money, and yes, prices have gone up, but now people are finally getting real wage gains again. We're still behind. People still have some catching up to do, but I think that catching up is really supported by what we're seeing in labor market factors. And that could really drive a consumer-led recovery and a strong economy and no recession. Now, of course, we know that unemployment lags, right? When this turns and we start getting mass layoffs, then that's when we start having rapid problems. But we're just not seeing that. We look at layoff trackers. Layoff trackers are like a third as high as what they were in 2023, at the beginning of 2023. But on top of that, you have to consider this. Layoff trackers are occurring a lot in tech and finance. But in tech and finance, that's where you have the excess jobs anyway. You're not really getting as many layoffs in restaurant, health, retail, certainly not government. If anything, that's where you're getting a lot of job gains. So this economy is on a lot firmer footing than what we'd like to think. Now, don't get me wrong. Gold prices are going up, partly because Chinese investors are going all in on gold ETFs because they think their economy is going to start, or their government, it's basically the same over there. Their central bank and their government is going to start basically stimulating again. So they're buying gold as a hedge. Some people see gold as a fear indicator that things are about to go really bad. And it is true, fiscal spending is off the walls and off the charts. You've got consumer debt, which is at record highs. But again, if people have the money to pay it, and we're not getting the leading indicator yet of layoffs or even warn notices, which we're not. Warn notices are relatively stable compared to last year. If anything, they're slightly trending down. Then maybe it's too soon to say the Fed needs to go for rapid cuts. Remember, they could cut 2% in a day. Why do they need to signal the start of rate cuts now and start moving down 25 bips? probably don't have to. Frankly, that at this point is not necessarily bad for the stock market anymore. The stock market is actually moving up as rate projections are moving up. So you're actually sort of saying, all right, economy's good. Rates aren't going to come down immediately. Party keeps going. So you've kind of switched to this good news is good news environment, as opposed to, oh no, yields up, stocks down. Not seeing that as much anymore. So maybe it doesn't even really matter. Maybe this Wednesday will be the biggest tell after all. This Wednesday is a day we not only get the Fed minutes, which kind of already expect to hear the same thing we've heard from the Fed meeting, so don't really care about that. What I care most about is going to be that CPI data. The CPI data for this month is critical. Why? Because you have CPI month over month expected to come in at 0.3, CPI month over month core expected to come in at 0.3 as well. And this data set for March is almost the equivalent of 3 CPI reports put together. Because if we get a bad CPI report this Wednesday, then it means January, February, March are all bad, and it's going to be bad news for the economy. Well, maybe not bad news for the economy, but it's going to be bad news in the short term for rate cuts, and then, of course, stocks that relate to rate cuts. If we get a good CPI report, it kills the bad news of January, February, and it basically just means solar eclipse, baby, moon. Oh, but what does that mean potentially going into CPI morning Wednesday? It potentially means we might end up seeing some aggressive selling. If it's anything like last week before the jobs data on Tuesday. So I wouldn't be surprised if we get some aggressive selling tomorrow into the close as people get nervous about, oh no, CPI's tomorrow, pull somebody off, and if we get a good CPI report, plow in, like back up the truck, plow in. So watch your trades over the next 24 to 48, because this CPI report could be the most important report of 2024. Let's see what happens. Keep in mind, if it's bad, you've already got people like Jamie Dimon, the CEO of JP Morgan Chase, saying, yeah, you know, rates might go all the way up to 8% or more.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.